One of the biggest features of the week, from a macroeconomic perspective, will be the annual meetings of the World Bank and the International Monetary Fund. They will run from the 15th to the 17th of October in Washington, D.C. Topics will include poverty eradication, economic development and aid effectiveness, as well as, perhaps more tangibly from the narrow perspective of financial markets, the World Economic Outlook. Indeed, the IMF will release its always interesting World Economic Outlook document, which it publishes twice a year and contains the latest forecasts for growth, inflation, budget deficits, and many other things besides. If you view this, however, as no more than a talking shop and prefer something perhaps a little more quantifiable, then the biggest macro item is likely to be the latest batch of economic statistics from China. On Tuesday the 12th of October, Beijing will release its latest year-on-year growth figures for retail sales, industrial production and fixed asset investment. The timing is particularly interesting, as the last batch for the month of August showed a marked slowdown. Retail sales rose just 2.5% year-on-year, industrial production rose 5.3%, and tangible fixed asset investment rose by 8.9%. Since then, however, the regulatory crackdown has tightened in several areas. Property developers' Evergrande's woes have deepened, and energy shortages have become more acute. The role of the Delta variant of COVID also needs to be considered, and economists have been cutting their Chinese GDP growth forecasts for 2021. This matters. China is the world's second biggest economy, and you can also already see the ripple effects in the form of lower iron ore and copper prices. And on the subject of prices, we get the latest Chinese inflation figures on Thursday the 14th of October. Central bankers the world over are now acknowledging that inflation could run a little hotter for a little longer than they'd anticipated, leaving us in the field of semantics when it comes to what they mean by transitory. Investors will be looking on with interest too, as the debate over whether the next leg of the economic cycle will be inflationary, stagflationary or deflationary continues to run. In August, in China, factory gate or producer price inflation surged again to 9.5% year-on-year, while consumer price inflation actually cooled a little to just 0.8% year-on-year. On the corporate front, the third quarter reporting season in America will kick off when megabank JP Morgan Chase releases its numbers on Wednesday the 13th, and events stateside may grab most of the headlines. However, we have a select slate of trading statements, analyst meetings and first half and full year results due on this side of the pond, and names which may be worthy of further research include the following: House builder Vistry and Bunzl on Monday the 11th of October, Bookmaker and Bid Target N10 on the 12th, JD Sports, Recruiter Page Group and another house builder Barrett on the 13th, Legal & General, Rio Tinto, Rank, Dunelm and another recruiter Hayes on the 14th, before Mediclinic rounds off the week on Friday the 15th of October. But the stock which could just cause the biggest fuss in the week ahead is online fast fashion retailer Asos. The AIM-quoted company is scheduled to release its full year results on Thursday the 14th. Believe it or not, Asos shares are down by more than 40% over the past 12 months. Yes, down. Now that may seem odd when everything we read talks about how online retailers are cleaning up at the expense of brick and mortar rivals. Yet neither Asos' first half nor third quarter results in April or July beat expectations. A problem for a stock that was then trading on a forward PE or price earnings multiple of more than 35 times at its year highs. Back in July, Chief Executive Nick Baton announced that third quarter sales had risen by 21% year-on-year, but that the final weeks of June had seen a bit of a slowdown. That was blamed on bad weather rather than the European Football Championships, but investors still took that as a bit of a feeble excuse. In addition, Asos flagged pressure on its gross margin from currency movements, freight shortages and product mix. When it comes to these full year results, analysts and shareholders will home in on two headline figures: sales and pre-tax profits. They'll look both at the final tally for the year to August 2021 and any guidance from Mr. Baton and his team for the year to August 2022. The current consensus estimate is for sales growth of 21% for the full year to around £3.9 billion. And for the year just begun, analysts are looking for a further 18% increase to £4.6 billion. And analysts are looking for a 35% increase in pre-tax profit to £192 million for the year just ended. For fiscal 22, they're looking for a more modest 5% increase to $200 million, partly thanks to a higher interest bill that's the result of a convertible bond issue. Above and beyond the headlines, analysts will then dig down for a few further items. They'll be looking for more detail on active customer numbers, site visits and sell-through conversion. A year ago, Asos had 23.4 million active customers, and that figure had risen to 26.1 million by the end of June, according to the third quarter update. Meanwhile, 2.7 billion site visits turned into 80.2 million orders for a 3% conversion rate in the year to August 2020. The retail gross margin fell to 45.9% last year, a drop of 1.5 percentage points, and that slipped again to 45% in the first half. The third quarter statement flagged cost pressures again, although an increase in sales of occasion wear may have offered some margin support as people started to go out again, as pubs, clubs, restaurants all began to open more fully. Finally, analysts and investors will look at the balance sheet. Asos had £92 million of net cash at the end of its first half, a big drop from the year-end thanks mainly to the £265 million Purchase of the Topshop, Topman and Miss Selfridge brands from the fallen Arcadia Group. Capital investment for the year is expected to be £160 million as Asos continues to spend on warehouse capacity in its platform. Investors will also look for comments on input cost pressures, stock availability, pricing and sourcing, especially as shares in online rival Boohoo took a pasting after its first half results in late September when they revealed a slowdown in both growth and margin pressures. All of the charts, by the way, only go back to 2012, as that's when the company shifted its financial year end to August in the case of Asos. I hope that you and your families are all in good health and good spirits. Thanks for listening, and I look forward to talking to you again next week.